On June 22nd, after news broke of a planned $20 billion massive bond issuance, SpaceX suffered its biggest pullback since going public, by the closing bell. The stock had plunged 16.4% on explosive volume, ending the session at $154.60. That drop shattered its IPO day closing price and vaporized roughly $400 billion in market value, marking the second largest single-day market cap loss for any company in history. Just a few days earlier, the picture on the secondary market had been drastically different. Ever since SpaceX hit the Nasdaq on June 12 with an offering price of $135, the company found itself at the center of a relentless global money hunt. Institutions of every stripe and frenzied retail traders, swept up in an unprecedented buying mania, rushed in and drove the stock price into a fierce rally at one point. It touched a near-term peak of $225.64, but in just 3 trading sessions, the maximum surge exceeded 60%. Total market capitalization skyrocketed to a pinnacle of nearly $3 trillion, vaulting SpaceX comfortably into the global top 5 most valuable companies. Yet from a wealth creation legend to a fallen idol, SpaceX covered that distance in less than 2 weeks. The abrupt end to this roller coaster ride boils down to a crisis of confidence within capital markets over Elon Musk's aggressive cross-border AI strategy. The relentless cash burn poured into AI ventures right after the IPO detonated a deep-seated panic about the company's future profitability. In the end, it forced Wall Street to reassess the valuation logic for this newly minted giant. As the heatwave receded and the bubble got pricked, the market was compelled to snap out of its space dream fever. Facing this grand capital spectacle, investors cannot help but ask, after the madness, where exactly does SpaceX go from here? More than $30 billion in potential rigid buy orders. When it landed on the Nasdaq on June 12, SpaceX instantly claimed the crown for the largest IPO in world history. Because of its trillion-dollar-plus mega scale, it directly triggered the fast-track inclusion rules of multiple major index providers, making it the first superstock to complete the entire accelerated inclusion process since those new rules took effect. So far, major global indexes have clearly announced their timetables for adding SpaceX. FTSE Russell reacted the most swiftly. Its fast entry rule allows a company to qualify after just 5 trading days of listing. That means SpaceX will officially be added to the Russell 1000, Russell 3000, and Russell Top 200 indexes after the U.S. market close on June 26. As for Hang Seng indexes and MSCI, Hang Seng announced it will add SpaceX to the Hang Seng Hong Kong U.S. Technology Index, with weightings recalculated after the close on June 23 and formally effective on June 29. MSCI likewise fixed June 29 as the day SpaceX enters the MSCI Standard Large Cap Index and the MSCI Global All Cap Index. The Nasdaq 100 index benefits from a new rule amended just this past May, which allows the top 40 new stocks by market cap to be fast-tracked after 15 trading days of listing. Consequently, SpaceX is expected to officially enter the Nasdaq 100 component list on July 7. By contrast, the S&P 500 remains the odd one out. While other indexes rush to relax their thresholds to welcome the behemoth, S&P Dow Jones Indices still rigidly enforces its hard criteria that a candidate company must meet 3 core conditions: a public trading history of at least 12 months, for consecutive quarters of positive GAAP earnings, and a public float of no less than 10%. Shackled by these rules, even if SpaceX delivers stellar post-IPO performance and boasts a leading market cap, it will not be eligible for inclusion in the S&P 500 until at least June 2027. The staggered inclusion dates of various indexes hold enormous indicative significance for the capital market's next moves. The logic behind it is crystal clear that ETFs and passive funds that track these mainstream indexes must strictly control tracking error and secure fund performance before the official inclusion takes effect. They are forced to build mandatory positions in SpaceX exactly according to the specified weights. This rule-derived rigid buying pressure offers powerful secondary upward momentum for SpaceX in the near term. So just how big is the buying power behind this round of index inclusion? According to estimates from Spot Gamma, the total global passive assets under management tracking Nasdaq 100 related indexes alone already exceeds $1.40 trillion, based on SpaceX's estimated weighting after listing. During the dense index inclusion window in early July, passive funds simply from the Nasdaq 100 and FTSE Russell index families will unleash a rigid buying demand as high as $22 billion to $27 billion. If you stack synchronized absorption from other index channels like MSCI and Hang Seng on top, total passive buying is expected to break through the $30 billion mark. The capital game frenzy. This short-term, rule-driven rigid buying will undoubtedly become the decisive factor in the tug-of-war between major players over the next 1 to 2 weeks. In the near term, it will release substantial tangible benefits on the tape. On one hand, although SpaceX's total market cap at listing approached $2 trillion, Elon Musk and early major shareholders were reluctant to sell. The IPO released only about 4.25% of shares into the float. Based on the $2.02 trillion market cap at the close on June 21st, the corresponding real float market cap stands at just around $90 billion. That makes freely tradable chips on the open market exceedingly scarce. Considering that more than $30 billion in passive funds will need to complete their position building within a short window of just over 10 trading days from late June to early July, this severe supply-demand mismatch can easily trigger a short squeeze and liquidity crunch on the tape.in. The near term, that might catalyze a second price surge, maybe even a new record high. On the other hand, SpaceX options debuted on June 17. Because the index-driven forced buying carries sky-high certainty, speculative sentiment in the options market has been fully activated. Masses of retail traders and hedge funds are front-running by buying call options to hedge their risk. Options market makers are forced to simultaneously buy spot shares in the secondary market. This creates a feedback loop. Stock price rises. Market makers are forced to add long positions, and the stock price accelerates upward. That classic gamma squeeze has become another upward propellant for the stock in the short term. It is precisely this unique tape dynamic that creates a prime left-side front-running opportunity for sharp hedge funds, high-frequency trading desks, and retail speculators. In fact, since the listing, multiple money flows have jointly launched a campaign, sweeping up scarce float in the spot market to lock up supply and deploying leveraged bets in the options market, continuously absorbing the market's limited tradable shares. They pushed SpaceX's stock price from the initial $135 shortly after the IPO on a rapid ascent, swelling the market cap dramatically within just a few trading days. The logic behind it is clear-cut. Position ahead of time, create the setup at elevated levels, and borrow the momentum to arbitrage. Speculative capital rushed to lock up chips before index funds could enter in size, artificially manufacturing a liquidity squeeze. When the major index inclusions formally take effect in early July, and tens of billions in passive money must build positions, those passive funds will have no choice but to take over those elevated chips from speculative hands. At that moment, the hedge funds and retail players who lay in ambush early, sitting on massive paper profits, can smoothly offload and cash out their gains. The passive funds, meanwhile, will end up as the ultimate bag holders in this grand capital hunt. After the glory fades, beware the risks. However, the real test will likely emerge in early July as the various index inclusion processes wrap up one after another. The roughly $30 billion in passive allocation by orders will all have been deployed and locked in. That also signals the market is about to step into a period of thematic vacuum where all the good news has been exhausted and only downside risks remain. Given that the S&P 500 will not even consider adding SpaceX until at least mid-next year, with no expectation of incremental passive inflows on the horizon, the hedge funds and retail coalitions that ambushed at low levels will very likely face a sensitive window for concentrated profit-taking, because SpaceX's actual free float is extremely scarce. A concentrated sell-off can easily smash through the stock's fragile price support, triggering an irrational price retreat and amplifying market panic. The driving force behind this latent risk is that SpaceX's short-term price mania has severely disconnected from its fundamental performance. Its pricing power has long been held hostage by micro-trading structures, options dynamic hedging, momentum chasing, and gamma squeezes. This self-reinforcing feedback loop driven by market structure, once it loses the momentum of incremental capital inflows, often becomes the dangerous starting point for a bullish reversal. When momentum flips, a cliff-like collapse becomes inevitable. In truth, SpaceX's high-altitude plunge is just one more iteration of the IPO curse that capital markets have staged countless times over the past 2 decades. A review of the 15 largest U.S. IPOs by size from 2006 to 2026 reveals a stubborn pattern for such mega listings. They generally hit their peak right around day 1, followed by a long, grinding correction. Among them, 87% saw their stock price decline in the first year. 1 year later, the average stock price had fallen 24% from the offering price, and the average maximum drawdown reached 50%. A classic example is the New Era automaker Rivian, which plummeted 68% in its first year. Even a powerhouse like Meta suffered a painful drop of more than 30% during its debut year. The only rare exceptions that broke this meat grinder curse were Snowflake, up 26%, and Airbnb, up 29%, among a handful of isolated cases. History often rhymes in startling ways. Today's SpaceX, both in its valuation magnitude and its trading structure, pushes this IPO curse to its extreme. While the astronomical scale has ignited market sentiment, the potential destructive force of a fall may also far exceed anything seen before at the same time. Something else merits even closer vigilance: SpaceX's potential influence on the broader U.S. stock market. First, the period from late June to early July is a concentrated rebalancing window for major indexes, adding SpaceX to maintain overall index weight balance. passive funds will simultaneously be forced to proportionally liquidate existing heavyweight positions. This mechanical repositioning can, to a certain degree, subject other tech giants to indiscriminate selling pressure as capital is drained away, thereby amplifying broader market volatility risks. Second, once SpaceX enters the mainstream indexes, its stock price performance will be tethered to the U.S. tech sector and the overall market. Its individual stock fluctuations will thus carry a market contagion effect. Although its tight float suggests that its initial weighting in each index will be limited, given SpaceX's directional and sentiment-bolstering role in the hard tech sector, its impact on the entire tech complex cannot be ignored. Because of the deep strategic controversy over its cross-border AI bets and the looming risk of passive fund buying exhaustion, if the company's stock tumbles from elevated levels going forward, it could directly drag the Nasdaq 100 and the tech sector lower, even triggering a rapid cooling of market risk appetite, especially against the current backdrop of overall elevated valuations in U.S. tech stocks and fragile market sentiment. The butterfly effect set off by a star stock could easily become the fuse that ignites short-term market turbulence at this juncture. No matter how you look at it, the core question seems to have long since detached from whether SpaceX is a good company that it has instead morphed into this. How much longer can this extreme trading structure, built on rule-based arbitrage and capital crowding, really hold up? When the next mega IPO arrives, will this capital spectacle, performed in the name of technological faith, but actually driven by rule-based arbitrage, simply replay itself? What is certain is that when the tide finally recedes, someone will ultimately have to foot the bill for this high-altitude bubble.